Hey everyone, welcome back. Today we're going to talk through a question that I get asked all the time, and that is, should I buy my next investment property in a trust? It's a big question and one that doesn't have a simple answer. So, to unpack this question in detail, I've brought in two people who I rely on when it comes to structuring and finance. First up, I've got my accountant, Anthony Huynh from Trover. He's been my accountant for the last 8 years, and he's helped me guide the structure behind my personal portfolio and my business. In fact, I had this exact same conversation with him just before I started buying my properties in a trust. I've also got Belen here from Hello Finance, my personal mortgage broker, and someone who's helped a lot of clients navigate the lending side of things when it comes to buying properties in a trust. Together, we're going to cover what a trust actually is, the pros and cons of buying in a trust, and some practical scenarios where it might not make sense to use one for your next purchase. Of course, this conversation is for educational purposes only and is not personal or financial advice. As always, we recommend speaking to your own accountant, mortgage broker, and lawyer to figure out what is right for you. But the goal here is just to give you a solid foundation to help you understand what a trust is and why investors are using it to buy properties. So let's get into it. All right, so Anthony, Justin, welcome.
Thanks for having me here today. So yeah, appreciate that. And I'm glad to be on the episode.
Yeah.
Thanks, Eric.
And welcome back, Justin.
Thanks, mate. It's good to be back.
So yeah, guys, this is something I really wanted to organize because it's a question that I get asked all the time. Okay, I always get like my clients or even people who are thinking about buying investment property, they come to me and they say, should I buy in a trust? And as a buyer's agent, I can talk to them and explain, what a trust is and at a high level what the pros and cons are. But then I always say, look, go talk to your accountant. Or you can talk to my accountant. And I've sent a few people to yourself, Anthony, and you've had these conversations with them. So I think it's good for us to just get into this setting, all right? And we'll just talk through everything in detail and talk through multiple scenarios so that, the viewers can get an idea of, certain scenarios that would suit them and whether the scenarios that you're talking about, Anth and Justin, would be suitable for them or whether it wouldn't. Okay, and then if they do need to go on and get that extra advice, they can either reach out to yourselves or their own personal advisors. Yeah.
Yeah, beauty.
Cool. All right. So what I'll do is I'll hand it over to yourself, Anthony, because you're the accountant and you've actually helped me set up my own trust structures and given me a lot of advice. So what I want to do with you is talk about, what is a trust?
Yep. So, you sent across quite a few clients in the last 12, 18 months, 24 months with this specific question in mind. And, it's a question I've answered 100 times before, so it seems quite like a familiar story here. But in a nutshell, in layman's terms, what a trust is, it's a legal arrangement whereby, and I say legal arrangement because it is not a legal entity its own right, a trust. So a legal arrangement whereby the trust will purchase a property or own investment assets, whether they be shares, cash, savings, cryptocurrency, whatever it is, you name it, but of an investment in nature. And the trust will have three particular roles within it. The reason why they are set up as a legal arrangement would be that the trustee, which is the critical component to it, which could be a person or a company, will hold the assets on behalf of the trust for the benefit of its beneficiaries. So generally speaking, and we are referring to what's called a discretionary or family trust is a term, in specifically that type of trust. The assets, whether that be an investment property in this instance, will be held on by the trustee on behalf of his beneficiaries, which are the family members. Now, it's important to note that the beneficiaries are not entitled to a benefit from the trust. So if you've got an investment property held inside the trust, it'll generate rental income, and the income is not an allocated fixed allotment to each beneficiary. It can be divvied up accordingly to how the trustee, which could be an individual or a company, defines or sees fit.
Okay. All right. So let's take it back a step. So it's basically a legal arrangement where the trust, I guess for the sake of this conversation, property, the trust can purchase the property.
Correct.
On behalf of
the beneficiary.
So
in a plain vanilla scenario, myself and my wife may purchase the property through said trust for the benefit of the beneficiaries, which could be myself, herself, or our children, our parents, our siblings, our children.
Okay.
Basically anybody within our family network.
So you're not buying the property yourselves, you're buying it through that.
Correct.
Through the trust.
Through the trust.
So tell me, I guess, let's pretend that I don't know anything about trust.
Sure.
Why do people do that in the first place?
Absolutely. So the most common term you probably would have heard of would be a trust fund baby, right? So I guess it's intended for generational wealth to be held inside one particular structure, shall we call it, to provide continuity to be able to provide for future generations, in a very simple format. Where it becomes interesting is from a practical sense is you may have the potential ability to redistribute the income across web or a number of family members, as opposed to having a rigid structure whereby if I had bought the same property between my wife and I, once again, a very vanilla scenario, 50-50, all the entitlement of the actual rental income would have to be paid out in that fixed entitlement 50-50. With a trust or discretionary trust, we have the ability to have not fixed entitlements or at our discretion to be able to redistribute that income across a number of people, which, as a byproduct, will give you an advantage of potentially lowering the average tax rate by paying it out across a number of people. Yeah,
so that's where you're able to use the trust for, I guess, tax planning and spreading the tax liabilities across the beneficiaries, which is one of the benefits of buying in a trust, which we will get into. I do want to bring it back to, I guess, more about the structure of the trust or why people do it, just so I can kind of wrap my head around it. So it's kind of like you imagine a family that just basically buys all their assets and they store it in a trust. Okay, so the asset could be property, could be shares or business, and it's for the purpose of storing it in a trust for their family and being able to pass it on, right?
Yes.
Why don't they just buy it in their personal names, and if they do need to pass it on, then it essentially does get passed on, like through wills and things like that?
Yes, it's because of the ability, I suppose, to redistribute that income across that number of people. So, for example, I may already be on the highest tax bracket, and every single dollar, so above 190K for argument's sake, and my wife might be in a similar situation. If I was to receive that income in my personal name, I may be paying tax at 47% in dollar or at the highest marginal rate. Whereas if you have the family network who potentially is on the lower income tax bracket or lower income earning than yourself, there is an immediate tax benefit there. I guess the other thing would be to consider is that by having the property, the asset held within the trust itself, and not in your personal name from a structural point of view, you are provided with the liability or the protection from anything that were to happen to yourself. So if you were to get sued by somebody or something was to happen in that instance, because it is held in a separate structure, although not a legal structure in its own right, you may be protecting yourself from a liability perspective that way.
Yeah, so that's the other benefit as well. It's asset protection.
Correct.
Yeah, got it. Cool. So I'm just trying to think. Yeah, I remember when I was first looking into buying properties in a trust, I had no idea. I didn't know that trust could be used for all that additional things. I remember you'd advised me of, having my business owned by a trust, right? And I was like, that's pretty handy because then you could have that tax planning benefits. But then buying a property in a trust, I was like, okay, so it's just buying a property through another entity, okay, or legal arrangement. And then as beneficiaries or trustees, I'd then be able to control it and still get the benefits from that property as a beneficiary. So one of the things that I was really interested in when it came to buying in a trust was the potential for the trust to allow me to preserve my borrowing power. Because at the time, my broker had told me, once you buy this next property, you're done, you're maxed out. And I was just like, no, I don't want to be maxed out on this next property. I want to buy at least 3 or 4 more properties. And that's when I was doing research and then finding out, okay, you could buy in a trust and then potentially preserve your borrowing power. And this is where I'll hand it over to you, Justin, to talk about, how exactly does buying in a trust preserve your borrowing power?
Well, just to build off the point that Anth brought up earlier, so a trust itself, or a family trust, or a discretionary trust, it's its own separate entity from yourself as the individual. So when you're looking at the borrowing capacity of the trust, you firstly start off on, you look at the income that's generated, or that's being generated within the trust, and you have a look if that income itself is enough to meet the loan repayments for the loan you're taking out in that trust. If the rental income, for example, if you're buying a property, is enough to cover the loan repayments, lenders will generally stop there when they look at servicing as a whole. Which is quite advantageous because it allows you to continue to build your asset base while preserving the borrowing capacity you have in your personal name. On the flip side to that, if you've got a strong applicant or if you've got strong income in your personal names, I've had clients in the past that they can still purchase another property in their personal names, but they're not ready to do so. They kind of want to preserve the borrowing capacity in their personal names for the purpose of buying their dream house later on. So what they do, they'll borrow in a trust because there's 2 components. So depending on the lender, they'd still want to make sure that yourselves as individuals can service your personal debts. And then if you've got anything left over there, then they can use that extra borrowing capacity to put into the trust to help you borrow more in the trust. But on the flip side of that, the beauty about borrowing in a trust is, so when you apply for a loan in a trust, they look at your personal position at that stage just to make sure you guys personally are okay. So fast forward, all good on the trust. You've bought property in there. The loan's taken over, everything's going well. And then back to this example where the person's now looking to buy their dream house. When we go for that application, the banks will then just focus on what they can do on the personal side and generally just do a sense check on the trust just to make sure the trust is ticking over and there's been no defaults or anything like that, and the repayments are upheld and maintained. And then we'll then just focus on the individual's borrowing capacity for them to buy again in their personal name.
So it starts off with the trust's borrowing power. And if that's self-sufficient, then that's all good. They'll still do a sense check just to make sure that the personal position is okay, because one of the key components is the security that you need to provide when you're borrowing in a trust. So there's a couple. So because it's a separate legal entity, you generally need a guarantee from personal guarantees from the owners of the corporate trustee entity. If you are going, if you do have a corporate trustee structure, and those 2 will probably be your main income generators. Which is the reason why banks will still do a sense check to make sure the people providing a guarantee are self-sufficient.
I guess to just run it back a little bit and just rewind about what a corporate trustee is. Because we probably haven't spoken about what the definition or what the roles within a trust are going to be. Which I think is important. So in effect, with the trust, there are an appointer, which is also known as like the guardian of the trust. So there could be an appointer or a guardian. Must be an individual, so it's a human, and it could be one or multiple, but they effectively hold ultimate control over the trust because they are the person or the people whom are able to remove or add the trustee. Critically, the trustee of a trust is an individual or a company. It could be a company, so you can have an individual trustee or what's called a corporate trustee, which is a company, which ultimately owns the assets held within the trust or is responsible for the assets held inside the trust for the benefit of its beneficiaries.
Okay, so the trustee essentially controls the operations of the trust.
That's right.
Okay, and the operations?
Yeah, I mean, the investment income or the assets held within it is liable also from a liability perspective, which is equally important to note as well, because, and generally speaking, that's why you would set up as a company in this instance, because a company is limited by liability. You would want to keep the value of that company as little, so they normally would be incorporated with $1 or $2 worth of shares. That's it. And obviously above that corporate trustee company, as Justin just mentioned, would sit the directors or
the appointer
of the corporate trustee company. There is one other role called the settler who is plays initially sets up the trust, or the person that commits some kind of form of money to set up or establish the relationship, shall we call it, and then they basically set that up. It typically would be the accountant or the lawyer that sets up the trust deed.
Pretty sure you were my settler as well for my trust.
That's right. And then they'll sort of step away from that role once the trust has to be established.
Okay. So it sounds really complicated there, but what I'll do is I'll try to kind of talk about it from the top and relate it to my trust, okay?
Sure.
So I've got a trust which I use to buy properties, and the appointer is me and my wife, and then we appointed a trustee company, right? So we set up a company to be the trustee. But then at the same time, my wife and I are the directors of that company, okay? And then we control the trust. And then after that, we're also the beneficiaries as well, okay? And then you and your team, or just you would be the settler.
Correct.
Yeah, cool.
So I've just got a question for Anne from the trust.
Yep.
So you mentioned earlier, so family trust, right, as an example. In the trust deed itself, do you have to list all the members family members within that trust?
No.
Or does it? Yeah. Can you talk through how you kind of capture who a family member is?
So depending on the trust deed itself, I mean, they're all written by different legal firms that would, and they're all will be slightly different from one another. But generally speaking, you would have a clause within the trust deed itself, which basically sets the rules, shall we call it? Within itself would be a definition of whom are beneficiaries and what can a beneficiary be defined as. Typically speaking, because it is a family trust or discretionary trust for the purposes of, or for the benefit of its family members, all of your family members are more or less included. And so if we look at it from a web, we look up and down the chain and sideways, that would include the main beneficiary, which would usually be the person setting up the trust, right? As a center point. And we go one up, which would include their parents, their children. If we go down, sideways would be siblings, but also includes nieces and nephews as well. So effectively anybody within your family network, but that would all be written, which means that your family or your direct family members would already be included as part of the trust as beneficiaries by default.
Really?
By default.
Okay. So say, for example, I'll use my trust as an example. It's just me listed, but obviously I'm married. I've got my fortunate enough to have my parents still alive, and my in-laws as well. So would they be captured?
Yes. It also includes its future spouses. It depends on the way that the deed is written, but it also could include future spouses, future children, anybody that comes into your life subsequently as well. We could also have the option to have a nominated beneficiary. So it could be somebody that that you want to specifically have as a nominated beneficiary to include their family pool as well. That is an option as well. But by default, your whole family, more or less, is already included.
As beneficiaries.
As beneficiaries. But just because they're included as a beneficiary does not mean that they are entitled to a portion of the profit or the trust income.
Because you have to...
That's up to the trustee.
Declare declare the distributions at the end of the financial year. Who's getting what?
That's right. So by law, with every single trust, there needs to be a set of minutes that are drafted and signed by all parties. And effectively what the minutes dictate is whom is going to be receiving what for that year. And it needs to be signed before the end of 30th of June, end of financial year. And typically the set of minutes will look something along the lines of, for my family trust, or I'd say, okay, the first 50% allotment of income will go to me or my wife. The next 20% will go to such and such person, and the next 10% will go to so on and so on. And therefore, just to clear off any doubts within that, if there was additional income that was unexpected or whatever for whatever reason, you can say, okay, the remaining portion or any additional income will go to myself, for argument's sake. That needs to be signed off, and the reason why we do it is then to ascertain how much income and what the pool of income is going to be, how it's going to be split to define that. And once we do the tax return post 30 June, we will follow it based on what the minutes were at that point in time.
Justin, do you want to talk about trusts again, I guess from a lending perspective? Like, how does that structure relate to the lending side of things and the benefits?
Yeah. So what am I start with? I'll start with back to what we were talking about before around the security structure, because after Anth's explanation just then around the corporate trustees or the trustees themselves, it'll make a lot more sense. So the borrowing entity will be the trust.
Yep.
Right. Now in that trust will own the asset, or will own the property that's being purchased. Now, to guarantee, the key difference between trust lending and lending in your personal name is the presence of personal guarantees.
Yep.
So stock standard, the property that you're purchasing will be used as security. Now, there's two different items. So there'll be a corporate guarantee. If you have a corporate trustee, the corporate trustee will need to provide a corporate guarantee and a general security interest.
What if it's a new company that you're setting up from scratch and a new trust that you're setting up from scratch to buy your first investment property?
That's okay. So even if it's new, the banks will still take, the security structure will still remain the same. Now, where the personal guarantees come into play is, so you've got the guarantees from the trustee entity, you've got the property as security. Now, the final piece is a personal guarantee from the directors of the corporate trustee. Now, the key reason being is those directors are generally going to be the main income generators of that trust. So back to Anthony's example, those two directors will be beneficiaries in that trust as well. But the reason why the banks say, for example, won't take a guarantee over, say, your 18-year-old son is because he doesn't really have control of where the distributions go. That's where the corporate trustee sits. And then the directors of that corporate trustee.
Okay.
Yeah.
Because I remember when I was applying for my first loans in a trust, we basically set up a new trust. Okay. We set up the new corporate trustee. My wife and I were directors of that corporate or company, trustee company. And then they basically just assessed our entire personal incomes. Okay. As if we were buying the property in our own names, because we're not buying it in our own names, but we're actually being personal guarantors for that trust.
For that trust.
So therefore, we're just as responsible for it as if it was under our personal names. So that's basically what it was, because the trust was new. It didn't have any financial history, and so was the company. And
and to add a layer to that, so what the banks would have done there, in the first instance, they would have seen what they would have, depending on the loan amount, they would have compared that to what the rental income would be coming in for that property. Now, if there's a bit of a shortfall, the reason why they then took that extra step and looked at your personal positions was to see if you had a surplus on your personal side to cover that gap in the trust.
Okay.
And generally in that situation, if there is, they'll give the green tick. Now, if I go back to the example where you asked if you could potentially preserve your personal borrowing capacity.
Yes.
So once the trust is set up, you've bought the property, the income's coming in, and then from there you look to purchase something in your personal names, provided that the trust is making its repayments, right? If you were to buy a house, say for example now your business continues to do well and it's time to buy the dream house or the family home, as long as your trust is self-sufficient, based on the financials, if it's turning a profit, the banks will be generally comfortable at that point to then not worry about or not factor in that debt in your personal application when you're looking to go to buy another property in your personal name.
Yeah, and that is, I think,
that's the key.
That's the magic of
that's
where
the
the
magic of
benefits
it.
of
Yeah.
buying in
Yeah.
a trust
I mean-
kicks in as a property investor. So basically, if you're buying a property within a trust, okay, and then that rental income
Yeah.
from that property is earned by the trust,
Yeah.
right? If that rental income can cover all of the liabilities,
Yeah.
which is the loan repayments,
Yeah. And any other expense, like you run your property
Yeah.
expenses through the trust.
Yeah.
Yeah.
yeah, and if it's all self-sufficient
Yeah.
because it's covered by the rental income, then essentially the trust
Yeah.
is positively geared.
Yeah.
And if you can prove that when
Yeah,
it comes
which is-
time to borrow
Which will
again.
be your set of financials.
Yeah.
And I guess the key difference, so I'll just go back to that example where, so when you first buy in a trust, they'll ask for your full financials, right?
Yep.
Just to make sure you're self-sufficient on one side, and if you need any leftover income from your personal side to help with the trust, then we're good. Now, the reason why they do that is, if you can imagine, so if you buy a residential property in a trust, it's still a home loan product.
Yep.
So if you're doing debt at the major banks, the banks will assess you on. So, the reason why with the rates high at the moment, while rental income generally won't cover your loan repayments, is the banks will assess you on actual repayments plus 3%,
Yeah, okay.
right?
Yep.
So with rates, so you're assessing deals at 9.5% these days,
Yep.
which would kill servicing for many people.
Yep.
Now, if I flip that example and say, hey, okay, the trust is done, all settled, and rental income's coming in. When the bank makes an assessment on yourself personally, if you're looking to borrow in your personal names, the reason why they're comfortable leaving the trust alone, if it's making a profit,
Yep.
is because now it's based on actual income coming in.
Yep.
And the like the interest expense in the set of financials for a trust won't be sensitized. It'll just be actual rates. So because they're dealing with actual numbers, the banks generally won't put a buffer on top of that.
Yep.
And that's why if there's a profit in the trust, it's self-sufficient, then they just focus on what's in your personal name. if
Does
you wanna
that
go
profit have to purely come from the rental income or income generated
from the
the
trust?
trust?
Yes, it does.
Yeah. So if I, put in some of my own cash as the guarantor for the trust, just to top it up because my property's a little bit negatively geared, does that count as profit in the trust?
That would be a question for your accountant.
I don't think it would because in that it's not truly self-sustaining
Yeah.
in its own
Okay.
right. I mean,
Yeah.
typically the nature of the activity within the trust, which is renting out the property itself, or the nature of the
Yeah.
income,
Yeah.
that one activity or that sole activity should be the one.
Got it.
One activity
Yeah.
that
Yeah.
should be the self-sustaining reason.
Yeah, okay.
Yeah.
Otherwise, if you're actually popping your own money into it to top it up, that's not income for the trust
Yeah,
for starters.
okay.
I was going to say on the flip side of that, if you're doing that, so that means there's a negative cash flow. So that will affect your borrowing capacity on the personal side
Got
because effectively you're relying on your guarantee now.
Because
to
the
make
banks
trust
will
work.
then say, okay, your trust is not self-sufficient. We now
Correct.
need to look at you
now
personally.
factor in that debt.
That's
Yeah.
right.
Got
Which
it.
means that the
Yeah.
debt will be included on the application. We have to pull it in. So
Yeah.
Yep.
I guess the argument is that, hey, that property is not owned directly by myself. It's owned within the trust, which is looking after its own debts in its own right with its own income generating, in this case being the rental income.
Yep.
Looks after all repayments, all good on
Yep.
that front over there. I should not have to declare that debt on my next application or my next purchase because it is standalone, independent of myself.
Yep. So the key to buying in a trust and getting that benefit of preserving your borrowing power, the key to that is the rental yield.
Yes.
Okay, so the rental income needs to cover all of the repayments
And expenses.
and expenses of the trust in order for, I guess, some banks to assess your application for your next property and realize, okay, this trust is self-sufficient. We won't include that as a liability to your personal name.
Yeah, and they gain comfort because there's a set of financials and a tax return that's done every year with the trust. So, yeah.
Got it. Okay. Anything else from a lending side of things?
What I say normally, with rates high at the moment, like we just say, for a trust to work, you probably have to maybe consider putting down a larger deposit.
Yeah.
With the way rates are at the moment. But from a lending perspective, that's the key bit is getting, if you're looking to purchase in a trust, is just getting prepared that it's still going to be treated as a normal assessment.
Yeah.
But it's once you get past that first hurdle, is the key, because then preserves what you can do in your personal name, provided that you have an asset that can, or you have a trust that can be self-sufficient. Yeah.
I think that's exactly what happened to me. So when I started buying in a trust, interest rates were only 2%. So every property I was buying then
everything was working.
Was positively geared.
Yeah.
Okay, 2%, 3%. Positively geared. So then when I went to buy again, they just excluded the debt and then allowed me to buy again in a trust. But then, in the last 2 years, interest rates have just skyrocketed across all of them. So now my trusts are no longer positively geared.
Yeah.
Okay, that's where I'm actually in a position where I'm maxed out and I can't buy again in a trust. I've got to wait for interest rates to come down. I've got to wait for those trusts to become self-sufficient again before I could go again. Let's go into the pros and cons of buying in a trust, okay? And I'm going to bring it back to you, Anthony, because we touched on this before, and that is tax planning flexibility.
Yep. So, I mean, for purchasing inside a trust or for utilizing a trust to begin with, we touched on asset protection and how it can provide you asset protection in the form that it is a separate entity or is separate from yourself as an individual. Yep. So therefore, if there is a potential that you are running a risky business, for argument's sake, that has the potential to be sued by a customer or by a supplier or whoever that may be, and you're worried about that, you would be able to purchase your assets or hold your assets. As a matter of fact, it doesn't specifically have to be property. It could be shares, investment income of any nature. Inside a trust, you'll be protected or may be protected from that instance that somebody wants to sue you. So first and foremost, asset protection. Obviously, the flexibility to redistribute the income as you wish. So that's the big key one, is that, and it serves a purpose for tax purposes from a practical sense, whereby you can distribute that income to people who are on a lower income than yourself. So as an example, if I have my parents potentially who are on very low income, not working anymore, potentially I could distribute that income into their name. So if I made $20,000 in rental income off the property and I'm already on the highest tax bracket paying 47 cents in the dollar, I could say, okay, I've got my parents who are maybe on low income. I'm going to distribute that income to them. They will declare that income on their tax return. If they fall underneath the tax-free threshold, great. We walked away from the 20 grand tax-free in a sense. What needs to happen from that point onwards, though, is that if you declare that income in said person's name, is you must, or you don't, not a must, but it'd be important to actually physically transfer the cash to them as well. Because what happens is once you distribute that income to that person's name on the balance sheet, or on the trust financials, it's going to be an IOU from the trust to said individual. And if we don't actually clear that out and actually pay the money into the trust, and this can be for another day, effectively it sits down there as an IOU from the trust and can accumulate over a number of years if you were to constantly distribute income to said person each and every year. So now you've actually created a legal liability to actually pay said person out. Where this is important is if you were to distribute income to your wife or vice versa, your wife was to distribute income to yourself, is that in some circumstances people may separate over a number of years. But if they've built up this amount of money that they've actually said they were going to distribute to said person over 5-10 years and accumulated a huge IOU, shall we say, that person can come back and say, hey, you've actually said you've distributed several $100,000 to me over the number of years, but you've never actually physically paid it out to me. I actually want the money now, and so therefore you have a legal obligation now to actually physically pay it out. So these things are important to check off.
Okay, now that you've mentioned that, I just realised I owe my wife a lot of money.
I mean, it comes with a lot of trust.
You should cut that.
I guess
it's good that you mentioned that, because we were in a situation where, well, not a situation, but like my wife was on maternity leave over the last few years, when we had our first child, when we had our second, and then during that time she took time off work and wasn't earning an income. So therefore, during those times, we were able to distribute profits from the trust into her name just to spread that tax liability and, I guess, minimise our tax as a household. Right? So we did say that I'd transfer that money over.
Yes.
Now I'm going to do it.
I guess the other thing is it does help with the continuity with the estate planning as well.
Yep.
And what I mean by that is it is a much simpler structure to hold an asset whereby if you were, once you pass away, to hand over to your children, because there is that continuity of that property being held within the one structure.
Yep.
And so therefore it really does make it a much more simple process for the purposes of passing on assets to your children.
Yep.
And in that instance, I mean, that's another common reason why people would establish a trust.
Because the trust lives on, right?
Correct.
Yeah.
But
That's
then
right.
if, say, the appointer
passes away.
Yep.
and or the trustees
Yes.
of that trustee company pass away,
Yes.
then you could essentially just get the beneficiaries, say it's the children,
Yes.
they can just take over as directors of that company. Or,
Yeah, that's right. So yes, because what happens in that instance is the trustee or the corporate trustee company,
Yeah.
if the directors of the corporate trustee company, i.e. the guardians or the appointer, were
Yeah.
to pass away, that company is still in existence at that point in time. So
Mm.
therefore, the company continues to trade, or I mean, the company is still in existence at that point in time of the directors passing. And so all we have to do is just appoint a new director.
Yep.
That also goes hand in hand with why banks will generally want a corporate trustee as opposed to an individual trustee for a trust when borrowing money for the most part,
Yeah.
because of that continuity.
Yeah, got it. Okay, cool. So we've talked about asset protection. Okay, so having assets owned in a trust could potentially protect those who are in high risk jobs or from being sued because they don't own the assets themselves. It's probably something that people should seek legal advice on, just
Yeah.
to confirm. You've got income distribution flexibility for
Yes.
tax planning.
That also, just to add to that, and something that's quite important, I feel, is that a big thing that people sort of overlook as well is, yes, it is good for you to be able to redistribute income here and now for the rental income,
Yep.
but you are also able to access the 50% CGT discount upon disposal of the property as well. So if you sold the same property, let's assume that we bought the property today for 650K, we hold on to it in 10 years' time, it might be worth $1 million or 1.5 mil. The profit or the capital gains tax is actually able to be redistributed across the board as well. And that's a big one, because if I was to buy a 650K asset in my personal name today and it was worth $1.65 million in 15 years and we made a $1 million windfall, sold the property, I'll be taxed on that whole $1 million in my personal name, which could push me into a very, very high tax bracket if I'm not already there. But the ability to redistribute that capital gains across a network of people, whereby each person might take a couple hundred or 250K each, we may be able to significantly reduce the effective tax rate by distributing that capital gains across a spread of people as well. It's not something that every investor thinks about, because there is an exit strategy in place as well, but it is something equally important to consider when you decide, what is the exit strategy here? Am I going to hold on to this property forever? Am I going to sell it at some point? What is the intention? And, it is something that every investor needs to significantly consider as well.
So spreading the capital gains across multiple beneficiaries.
And that's like the sale of any asset within the
Correct.
trust.
Yeah.
It could be your the shares inside your company or your business that you own as well. So I commonly refer to the trust as that mothership that holds the interest in any investments that you own.
Okay. Cons of buying in a trust. Okay. Anthony, again, talk me through some of the cons.
Yeah, I mean, obviously there are some setup and administration costs, accounting fees that you need to consider. Generally speaking, the big consideration that needs to be played here when purchasing, and this is specifically property related, is the land tax component. So generally speaking, if you were to purchase an investment property through most states in the country, you would be up for land tax right from the very get-go. If it was the first property in your personal name in a specific state, for example, you will get access to the land tax free threshold, which means that you may not have to pay land tax on that first property, potentially.
Yeah, I know that. I think if you buy in your personal names in Queensland, you could probably get away with one or two, depending on the value of the property and the land, you could probably get away with buying one or two in your personal names in Queensland before you hit the land tax threshold and have to start paying land tax. I think in New South Wales there is a threshold as well. But then if you buy in a trust in New South Wales, then straight away
Yes.
you've got to pay land tax.
Correct. So the trust has no access to the land tax free threshold. It pays from the very first property right from the get go.
Yeah.
So I guess it becomes a question of there are citizen investors that have already bought maybe a couple properties in New South Wales and have a couple in if they're built, whereby you wouldn't need to consider land tax because they may have already exceeded the threshold. And so whatever they purchase in their personal names or inside a trust will lead to the same outcome. But it is, once again, a case-by-case scenario. There is no plain vanilla advice that you can give to everybody as across the board. It is a case-by-case scenario. So I do encourage clients to ask the question, say, hey, these are my set of circumstances as to where I am now.
Yep.
And the approach or the advice off the back of that will be quite tailored to the individual.
Yeah. I mean, at a very high level, like generically, I would never advise a client to buy in a trust or not buy in a trust just to avoid land tax. Yeah, it's just not the way. It's not the reason why you buy in a trust.
Yes.
Okay, and avoiding land tax should never be a reason to buy in a particular state or not. Okay.
Absolutely.
So setup costs, okay, and accounting costs are the cons. Okay. Also ongoing compliance. Okay. What does that look like?
In terms of dollar spent or?
Just the trust?
Yeah, so what would happen is the trust would actually have to lodge a tax return each and every single year.
Yep.
The minutes would have to be drafted up once again. So we do a tax return and a set of financial statements. It's quite similar to a company, no different to that.
Yep.
Record all the income, record all the expenses. It's more or less what a rental schedule would look like in a personal tax return on a trust return. Although, because we have to prepare the set of financial statements, so there is one extra component we would do. And then from that point onwards, we would have already ascertained what the distributions were going to look like pre-30 June.
Yep.
And then those distributions will get paid out or declared on another statement called a distribution statement to the beneficiaries of the trust, whoever receives the income.
Yep.
And then those beneficiaries have to declare that income on their personal tax returns.
Yep. Okay. All right. So there's a lot to do.
Yes.
Hence the extra costs.
Yes.
Yep.
The other one thing I should mention as well is that a beneficiary doesn't have to be an individual or a person. We could have what's called a corporate beneficiary, which could be a company that can act in place as a beneficiary. There are a set of circumstances that we have to tick off the list to be able to enable that. But what that allows us to do is potentially to cap the tax rate at 30% or maybe even 25%, depending on the circumstances. And it is a little bit more of a more complex structure, but it is something that is taken into consideration by some investors these days.
Cool. Justin, from a lending perspective,
Yes.
what are the cons of buying in a trust?
Would it just be, so buying in a trust, there'll be just probably two layers that you'd have to look at. Being you'd have to make sure, you'd have to assess the trust itself, so the property and the rental income coming in. And then then the banks will do a sense check on yourselves personally, or whoever the directors of the corporate trustee are.
Yep.
They do an assessment based on them as well. So there's two layers of assessment. The trust loans are slightly higher than your standard home loans in your personal name.
The interest rates?
The interest rates, sorry.
Yep, I know.
Yeah, they're slightly higher.
A lot higher.
Yeah, a lot higher. But from a cons perspective, it's still kind of like I generally just limit it to those two items because it's still, irrespective if you buy in a trust or in your personal name, you're still going through a credit assessment.
Yep.
Policies are generally quite similar, so you'd still need to put down a minimum 20% deposit and the like. But from a cons perspective, it's just probably just a bit more tedious.
I know.
In terms of documentation.
From my experience, when it comes to borrowing in a trust, there's a lot less lenders who will borrow.
And your lender pool is a lot smaller.
Yeah, because it's considered as a complex lending structure, so not all the majors will do it. So it's a lot more complicated. There's less lenders, so less options. And then when you do find a lender who will lend to a trust, the paperwork is just a nightmare. Okay, they require so much documentation. It's just very, very tedious. takes a lot longer.
Yeah.
I've also noticed, and it may be a little bit different now, but back when I started, it wasn't a very common thing. And there may be like a lender that does trust lending,
Yeah.
but then there'll only be one person in that entire company that
That
can
knows how to assess it.
that knows
Yeah.
how to assess the trust
right.
loan.
Yeah,
But
yeah.
I think it's improved
It's gotten
now.
better now.
Yeah.
The only other thing I would add as well, from my experience working in the banks previously, not all trusts can actually borrow.
Yep.
So there's a legal expense as well, where you have to get an external solicitor, or the banks get an external solicitor to vet the trust deed, just to make sure that the trust is in fact able to borrow money to purchase a property.
Yep.
So that's another legal consideration that you'd have to think about as well.
Yeah.
Yep.
There is one more con to a trust that probably should be mentioned. Is that losses within the trust are actually quarantined?
Negative gearing.
Correct.
Can't claim that in a trust.
Correct. So, in a typical scenario, if you were to purchase the property in your personal names individually, and the property was negatively geared, i.e., turning a loss on paper,
Yep.
that would reduce your taxable income, and therefore you would get a tax refund, or you would actually be saving tax
Yep.
in that instance from that negatively geared property.
Yep.
We can't draw the same conclusion with the trust. With a trust, the loss is actually quarantined or stuck within the trust itself.
Yep.
And so therefore, what happens is you as an individual cannot distribute a loss from a trust to you yourself or to a beneficiary. They are stuck or quarantined within the trust to be carried forward to a later income year or the next year to be offset against future profit.
Future
And
profits.
so what that means is that we are able to absorb the losses overall, provided the income is actually absorbed with, by carried forward losses in a later income year, but it becomes a timing benefit. So you can't claim that loss here and now in this income year and get the immediate tax benefit there. It is actually carried forward to a later income year. When the actual trust makes overall profit.
Yep. So you can't claim that negative gearing from your trust to get a bigger tax return now, but you slowly realize the benefits as it offsets your future profits.
Correct. So it becomes a timing benefit. It's not about whether you will receive the benefit or not. You do receive the benefit, but in a later income year, so not here here and now. But that takes into consideration time value money.
Yeah, that was a big thing that I had to consider as well, because after building a portfolio, I did have like all of my properties, even though they were positive cash flow, once you factor in all the expenses and the depreciation, those properties were negatively geared. So then I was actually able to claim a loss of like 5 to 10 grand on each property per each financial year, and we were able to get that back in our individual tax returns. But then when I bought in a trust, we couldn't do that because the losses were quarantined inside the trust.
That's right.
Yeah.
And then that shows up from a lending perspective as well. So when you borrow in your personal name, you get in a lender servicing calculator. There's negative gearing benefits, so which will boost up your potential borrowing capacity, similar to a trust. If you can't claim negative gearing in a trust, there's no negative gearing servicing benefits when borrowing in a trust from a lending perspective as well. So that's just another thing to consider.
Okay. So I'm going to kind of bring in my own situation here when I was buying in a trust. Okay. So for me, it was a hard decision to make. So my big goal was to keep accumulating properties, but then I was worried that I was going to get maxed out. But then if I was to buy in a trust, I'd be up for extra accounting fees, setup fees, and your accounting fees aren't cheap either. And then at the same time, negative gearing wasn't going to be included. Okay, well, I couldn't claim that negative gearing. But ultimately, I did decide to buy in a trust because the most important thing to me was to be able to preserve my borrowing power so that I can continue accumulating. Okay, so that's ultimately why I did it. Like, I mean, asset protection wasn't really a big deal for me. Tax flexibility or tax planning, that was a benefit, and that's helped a lot. But ultimately, I made that decision to buy in a trust so that I could continue borrowing. So what I want to do is I want to talk about, I guess, when you should or shouldn't buy in a trust. General advice, of course, because there's going to be different scenarios, Anthony, where you've got all of your clients coming to you saying, should I buy in a trust? And you're going to look at their situation. And I know that there are in some cases you would say, you know what, I reckon you should buy the next one in your personal name.
Yep.
Okay. But then there are other times where you're going to say, you know what, your next one, do it in a trust. So talk me through that. And you can weigh in as well,
Yeah.
Justin,
Yeah.
from a lending perspective.
Sure.
Absolutely. So I guess it is, just to reiterate, it is not a one size fits all solution. Generally speaking, from what I've observed, just speaking to, having had these conversations so many times, the one type of buyer that would consider or strongly consider a trust will be that they have want to acquire or an aggressive approach to buying property. They're buying multiple properties for that matter. Over a period of time and said, okay, I don't want to stop at 1, 2, or 3. I want to buy the 5, 6, 7, 10 properties. At the same time, I am understanding that there is going to be a cost consideration in doing so, i.e. the accounting fees, the setup costs, the ongoing, etc. But my ultimate goal is to acquire multiple properties whereby I wouldn't have been able to do it by just buying it in my own name and capping myself that way.
Yep.
But the typical questions I would then ask the client would be, where are you going to buy? What state are we buying in? What's the purchase consideration? How much deposit are you going to be throwing into it? Also, what is the expected rental yield? What are the expected costs? And we do it on a case by case scenario and do an analysis off the back of that to say, okay, maybe this property is going to be positively geared from day one. Maybe this is going to be a circumstances that will fit your criteria to enable you to preserve your borrowing capacity.
Yep.
But obviously, we hand that back to Justin, to the specialist, to double check in on and say, okay, this all fits this criteria.
Yeah.
But it is, once again, a very tailored approach on each property. So my clients, just because they've done that approach and purchased trust in the first property, the second one might be a different set of advice once again, because each set of circumstances warrant a different scenario or different structure potentially.
Yeah, okay.
Yeah. I've just got a follow-up question off the back of that. A question that I get often as well. Would you purchase one property in one trust, or would you, or people ask, why can't I just buy 2 properties in the same trust?
Yeah.
Or is it better to buy one for set up a trust for each one?
It is a question that's a very common question once again. There is no clear-cut answer to it. Yes, you can buy multiple properties potentially through the same trust and achieve the same outcome. But the problem with that is if you had one property potentially that was hugely negatively geared and then one that was hugely positively geared, but you had them both sitting inside the one structure and then you end up in an ultimately negative position overall, that may hinder your potential to buy the next property. Whereas if you had them split up in separate trusts, you had one that was positive and one was negative, we may only have to disclose the debt in the one that is negative. That's effectively what you have from a practical point of view. Obviously, there's risk and liability all held within the one trust, but we're talking about property. What's the risk of you're getting sued for an investment property? Very, very low chance. So I don't generally have to consider that, but the other one, we do.
Okay.
And I guess from a lending perspective, what we look for trust, or what an ideal client for me would look like, is just, so everyone's different, it's case by case, but you'd probably, the ideal customer would have to be ready to go with some decent deposits. Have a deposit
to buy in a trust.
To buy in a trust, because trust lending is pretty stock standard. 80%, you can potentially go more, but there's no, the key difference as well, there's no LMI. Like, you can't pay for LMI if you borrow in a trust. LMI is only reserved for personal borrowers. So which comes back to,
There's no LMI for trusts?
No.
Oh, wow.
Yeah, LMI is just reserved for individual borrowers.
Okay.
So, which goes back to my point where it's really like the ideal client would really have to have sufficient deposit funds ready to go.
So that they could minimize the repayments.
Minimize the repayments to get it as close as possible to your rental income being able to cover the loan repayments.
Positive cash flow,
positive
self-sufficient.
Self-sufficient. But that's really the key consideration. I'd only really suggest clients to buy in a trust if they've got decent cash balances behind them, to get that property as closely positive geared as possible.
What if they're just buying their first property?
If it's just their first property, whether or not that be investment or owner occupied, I would definitely, if it's your first property, I'll definitely buy it in your personal name.
Yeah.
Because then you've got potential availability of those first homeowner concessions as well.
Yeah, true.
Depending on the value that of the asset that you buy, and if it's your first property, your borrowing capacity is going to be at its best as well.
Yep.
So generally, the first one you would go in your personal.
Depends
names,
on the type of asset you buy.
Yeah,
right?
of course.
If you're going to go and buy an owner-occupier home and just absolutely max out your borrowing power on that, then it doesn't really make a difference.
Doesn't really make a difference, but
yeah.
again, you'd still do it in your personal name. I
Yeah.
feel for your first few.
Yeah.
Yeah.
Okay. Anthony, are there any other scenarios where you would say is suitable for a client to... Actually, I'll ask that again. Anthony, are there any situations where you actually advise someone, don't buy in a trust, just buy it in your personal name?
Yeah, it's, there'd be the circumstance where you don't have anybody to distribute income to, period, potentially.
Yeah.
Yep.
So in that instance, I mean, ultimately, because the trust is actually there to redistribute income or to be able to provide benefit to your family members, there may be some people who don't have anybody to distribute income to at all.
Yep.
So ultimately, the net effect of having a property inside a trust, or the point of having a trust in the first place, is negated. There is no benefit in holding a trust.
So you're basically, that person would be creating extra complexity, extra accounting fees,
Correct.
setup fees, just to essentially...
For zero
Distribute
benefit,
to
yeah.
himself.
Yeah.
And it does happen from time to time.
Yeah.
I do have some clients that fit inside that boat, right?
Yeah.
But and so our trust is not something that we'll consider in that instance at all.
But if that person was an individual and they had maybe a couple of properties under their name, their personal name, they're getting close to that breaking point that you said, Justin. Would you then maybe think, okay, maybe a trust for the next one?
Yeah.
By that stage as well, if he's got two properties, probably he's built some equity through those properties as well. So the potential of him having a deposit or being able to pull out for a deposit to put towards the next purchase, will be better. Yeah.
Just before we wrap up this part, are there any common mistakes or misconceptions about setting up a trust?
Everybody tends to think they're a very expensive setup, and but it is a quick process, is what I'd say. Provided you have all the information ready to go, it's not an overly expensive setup. And sometimes the benefits that you actually get out of it are immediate. So it's something that you probably have to go back to your advisor and get confirmation on as to whether it is going to be beneficial to you from a tax perspective. But no, there's nothing else I'd say as a misconception.
Maybe a misconception from the lending side that there is word out there that if it's in a trust, it's ignored.
Yeah.
But that's more so on the flip side if it's self-sufficient, right?
Yep.
The key thing is, so which comes back to the strategy of buying assets in a trust. You probably want them as close to positive geared as possible, so they can be ignored. Also, the debt can be ignored when you're looking to go again in your personal name.
I think that's the biggest misconception.
Yeah.
Like you said, people think that if it's in a trust, the
We're
debt will be
good
ignored.
to go. Yeah.
The key to that being possible is the trust being self-sufficient.
Yeah.
And in such a high interest rate environment,
It's tough at the moment.
it's very hard. But maybe as interest rates come down, like those properties that were bought in trusts, I guess in the last couple of years, they will eventually become self-sufficient. And then the
going
benefits
back,
kick in later on.
And going back to your example, when you were buying those ones, when they were at 2%, they were positively geared straight away. So it's just timing, I guess.
Those debts are not being ignored right now when I'm trying to get more lending. But maybe in a couple of years' time they will. Yeah. Cool. Just before we wrap up, I would say to both of you guys, what would you say to someone who is tossing up whether or not they should buy in a trust or not? I'll start with you, Anthony.
I'll need to see the numbers. I'm a numbers person. That's what we do, right? Give me the feasibility. Show me the numbers. Once again, what state are you purchasing? That's an important question to ask.
Yep.
What's your deposit? What are you looking to borrow roughly? And then we can sort of manipulate and manufacture where sort of have a look and see, whether a trust is feasible or not. So, it's a lot of analysis on the front end, and we only can provide advice as good as what the client provides to us. So generally speaking, that would happen once they sort of located the property and said, okay, I've got an idea of what I'm going to do, and they'll speak to somebody like yourself. So, okay, this is what we think we are going to get or taking serious consideration on. At that point onwards is where I can sort of step in and help.
Yeah.
Yeah.
So there's quite a process to,
Yeah.
Yeah,
to
absolutely.
you giving the advice as
Yeah.
to whether you should buy in a trust or not.
Oh, absolutely.
Yeah. What about you, Justin?
And then just off the back of that, if it's someone walking off the street and asking me straight up, obviously I'll just literally ask, okay, what are your plans? How many do you want to get?
Yeah.
And then off the back of that, I'll be able to tell you if the trust path is something that we go down in the future. But if you come in and say, I'm happy with an owner occupied and one investment property, then it's probably better off in your personal name. But if he comes in and says, I actually want to go 5 properties in 5 years, then we start planning off the back of that. So it's just figuring out where they want to end up and seeing and then off the back of that you'll be able to tell trust may be a path we go down.
100%. I think the key here is if anyone's thinking about buying in a trust, it's very important to get the right advice.
Yeah.
Okay, from an accountant, mortgage broker, to get an idea of the lending side of things, and even a lawyer, just to understand the asset protection side, but even like how the entities are structured as well. I think we've covered a lot today. So for anyone here watching, if you ever want to chat further about whether a trust is for you or not, and you would like to chat with an accountant who is very experienced with these structures and dealing with and working with property investors, then by all means reach out to Anthony and the team at Trover Tax. If you are looking for a mortgage broker to help you with trust lending, or you just want to bounce ideas or understand your scenario, reach out to Justin at Hello Finance. So I think that's a wrap, guys. So thank you for your time today, and I'll chat to you again on the next one.
Yeah, thanks so much for your time, Eric. And we'll catch you on the next one. Can't wait.
Thanks, Eric. Can't wait for the next one as well.